Welcome to May. The sun is shining, the flowers are blooming, the birds are chirping. So is it time to sell stocks and go away? Our next guest says not this year. So we took a look back on the old Wall Street adage, and over the last 6 years, the S&P 500 was only negative once from May through October and was higher, an average of almost 5% during that time frame. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. So stay in May? Is your adage?
Play in May.
Play in May, stay in May. It's all good in May. Really, Mel, you just don't have the conditions that typically exist to expect a negative May through September period. And by definition, the adage don't sell in May and go away means you actually go to cash. And the conditions that typically take place before that happens is you're only less than 2% median from a 52-week high. We're down 8% from the 52-week high. Also, in all 6 non-recession negative May through September periods, you had a ramp up into May by a median 8%. So we're down for the year. It would be historically unique to have a non-recession negative May through September period since 1982 when you're down more than 2% from the 52-week high and when you have a negative period ahead of May.
I get that, but does that necessarily mean that you want to stay invested in May?
Sure. If you're not down and the latter half of the year is good. Remember, ultimately, the market correlates to the direction of earnings. So this is all noise. Unless you expect a negative period of earnings, you should never not be invested anyway.
What's going on right now, then, in earnings, in the market's reaction?
Back in January, when we were talking on set, Tim pressed me on it, what we thought was going to be a pretty meaningful correction. There was. And then we were calling for a retest. There was a lot of pushback on that. Everything looked great. Now it's the opposite. We are working off a ridiculous level of optimism that took place in mid-January. I mean, think about it. When you turn on the news, watch the news, or you look on the internet at a newspaper, you see negative stories. You don't see, hey, everything's good. So to have only 12% of Investors Intelligence newsletter writers negative in mid-January, that is a ridiculous level of optimism. Negative sells. So when you're a newsletter writer and you're not negative, you're kind of shooting yourself. So there was just such a degree of optimism, Mel. I don't think this is about anything other than, yeah, you're slowing from peak growth. The market doesn't correlate to the rate of change of earnings. It correlates to the direction.
Just to play devil's advocate quickly, the volatility index is now pushing down towards 15 again. Do people get that complacent that quickly? Is that something we should be concerned about?
It's historically what happens, Guy. It's a great point. The indicator we used for the shock drop back in post the February move was you had on a 10-week rate of change on the VIX index, the volatility index. It got up to 125. Whenever it's gone from that level on the 10-week rate of change to below zero, you've made new highs. And volatility has come down, and it's stayed down. So I would expect it to break 15, stay below 15 for a period of time. I was at an Ironman, which you actually ran in at one point. I was at an Ironman this weekend with some college buddies.
I thought you said you were in an Ironman.
No.
Like, wow, Tony, that's
amazing. I walked 15 miles at the damn thing. I felt like
that's pretty good.
But, I was with my buddies, and everybody's skeptical about the stock market now. But when you ask them, well, how's your business? Well, it's good. You got to have a negative environment to be sustainably negative. The rest of it really is short-term nuance.
So obviously, depending on a horizon, is who cares about May on some level if you're looking longer term?
Right.
But the point I've made a couple times tonight is that I think the economy can be great, earnings can be fantastic, but it doesn't mean stocks have to trade at the multiple they traded at yesterday. I get why stocks traded at a very significant multiple when rates were low. Companies were given a lot of benefit of the doubt. Why should they be trading even where they were 3 weeks ago?
Well, Tim, historically you traded a 19 multiple when core inflation's between 1% and 3%. And it's not 20 because of this cycle, because it's traded for so long below 20. So when you think about that, coupled with inflation is still at under 2% on the core level. So let's think about, is the market discounting the caution or the optimism? We came into this year trading at 20 times. If we end this year, I can't imagine a scenario where my 155 number for S&P operating profits is too high. So if that's true,
you'll get there,
you're at 17 times at the end of this year. In other words, you've had a 3 multiple point contraction already if you say prices are going to stay where they are. I just don't think there's any way that's going to happen unless you get the Fed to do some kind of crazy spike in rates, which 3 or 4 of the Fed governors have already said we don't want to invert the curve. So they're paying attention to that story. So I'm saying, yes, when you look at the trailing 12, maybe the multiple is still high, but at the end of 2018, when you're going to have greater than 25% earnings growth this quarter, if you're going to have greater than 20% earnings growth this year, no recession next year, which means even positive next year, now you're at 160 something in earnings. That's a hard thing to say you're going to be at a 17 multiple with no recession in sight.
Tony, good to see you. Thank you.
Great to be here. Thanks, Mel.
Tony
Thanks,
Dwyer,
Timmy. Thanks,
Canaccord
buddy.
Genuity. Are you feeling good about this period May through October? I mean, not that, I mean, you're a long-term
I'm a
investor,
long-term
but do you feel like
investor.
that there are things in the market that they're underappreciating?
Yeah, I do. I think that, you know, Alphabet I talk about all the time, those cat earnings, I actually thought those were completely misunderstood. That call, I think, was, I don't know why everybody's hair was on fire over that. So, yeah, I'm in Tony's camp.
There's no leadership right now. I mean, that's the biggest problem. And the leadership, you know, everyone goes back to FANG, and it's very narrow. So when you talk about XLI, you know, industrials, people were excited about that, and then you had this earnings cycle where they just rolled over. I mean, they just rolled over. And who cares what the CFO said? Is the price action that's so important. So we talked about healthcare, disaster. You know, banks showing really bad relative underperformance right now. Staples, disaster. Energy is too small to even care about, right? So if FANG comes undone, you know, everything Tony just said is all fine and good. It's all historical data.
Right.
We're going to have some new history very soon is all the only point.
And what happened to, I mean, 50% of the XLF is in at least correction territory, if not worse.
Yeah, and I got to tell you, coming out of earnings season, the banks are the numbers I like the best. But I think the technicians are in charge, and I say that because I think that you can see lower highs continue to be made. I'm trading emerging markets from, you know, tactically the short side, or at least to the lower side, for the next couple of weeks.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.